Bonds are a type of debt security that are issued by companies and government entities to raise capital. The price of a bond is determined by a number of factors, including the bond's face value, coupon rate, maturity date, and the overall level of interest rates in the market. The face value, also known as the par value, is the amount of money that the bond will be worth when it matures. The coupon rate is the annual interest rate that the bond pays to its holder, usually expressed as a percentage of the face value. One of the key factors that affects the price of a bond is interest rates. When interest rates rise, the price of existing bonds falls, because new bonds are being issued at higher rates. Conversely, when interest rates fall, the price of existing bonds rises because they are paying a higher rate of interest than new bonds. The yield to maturity, YTM, is the rate of return that an investor can expect to earn if they hold a bond until it matures. It takes into account the bond's coupon rate, price, and the time remaining until maturity. It is an important concept when evaluating bonds as an investment. It's important to note that when bond prices increase, the yield to maturity will decrease, and vice versa. This inverse relationship is known as interest rate risk. It's also important to note that the yield to maturity is an important measure when comparing different bonds, as it takes into account the bond's coupon rate, price, and maturity. This allows investors to compare the expected return on different bonds and make informed decisions. In summary, bond price is determined by a number of factors, including the bond's face value, coupon rate, maturity date, and the overall level of interest rates in the market. Yield to maturity is the rate of return that an investor can expect to earn if they hold a bond until it matures and takes into account the bond's coupon rate, price, and maturity. Understanding these concepts can help investors make informed decisions when evaluating bonds as an investment. Thanks for watching another episode of Finance in 2 Minutes, where we make finance less boring than watching grass grow on a rainy day. Before you go, don't forget to hit that subscribe button and join the club of financially savvy people who also have a sense of humor. Because let's be real, if you don't invest in your financial education, you'll end up like the person who invested all their savings in a company that makes something ridiculous like a unicorn-shaped paperclip. See you in our next video.